Wish you all a very healthy and a very wealthy Happy New Year 2021 and wish you lots of learning. So let's start with today's session, the technical analysis series part 4. What is volume? Volume is simply the number of shares or contracts that trade over a given period of time, usually a day. The higher the volume, the more active the security. To determine the movement of the volume, that is up or down, chartists look at the volume bars that can usually be found at the bottom of any chart. Volume bars illustrate how many shares have traded per period and show trends in the same way that prices do. Why volume is important? Volume is an important aspect of technical analysis because it is used to confirm trends and chart patterns. Any price movement up or down with relatively high volume is seen as a stronger, more relevant move than a similar move with weak volume. Therefore, if you are looking at a large price movement, you should also examine the volume to see whether it tells the same story. Say, for example, that a stock jumps 5% in one trading day after being in a long downtrend. Is this a sign of a trend reversal? This is where volume helps traders. If volume is high during the day relative to the average daily volume, it is a sign that the reversal is probably for real. On the other hand, if the volume is below average, there may not be enough conviction to support a true trend reversal. Volume should move with the trend. If prices are moving in an upward trend, volume should increase and vice versa. If the previous relationship between volume and price movement starts to deteriorate, it is usually a sign of weakness in the trend. For example, if the stock is in an uptrend but the up trading days are marked with lower volume, it is a sign that the trend is starting to lose its legs and may soon end. When volume tells a different story, it is a case of divergence, which refers to a contradiction between two different indicators. The simplest example of divergence is a clear upward trend on declining volume. Volume and chart patterns. The other use of volume is to confirm chart patterns. Patterns such as head and shoulders, triangles, flags, and other price patterns can be confirmed with volume, a process which we will describe in more detail later in this tutorial. In most chart patterns, there are several pivotal points that are vital to what the chart is able to convey to chartist. Basically, if the volume is not there to confirm the pivotal movements of a chart pattern, the quality of signal formed by the pattern is weakened. Volume precedes price. Another important idea in technical analysis is that price is preceded by volume. Volume is closely monitored by technicians and chartists to form ideas of upcoming trend reversals. If volume is starting to decrease in an uptrend, it is usually a sign that the upward run is about to end. Now that we have a better understanding of some of the important factors of technical analysis, we can move on to charts which help to identify trading opportunities in prices movement. But before moving further, I would like to request you all to share my YouTube channel link with other people on other social media platforms like WhatsApp groups, Facebook, Instagram, Quora, LinkedIn. So others can also take the advantage of learning because many are not aware of the channel. So I would really like to request you all to share with maximum people on different social media platforms. And let's continue ahead. Chart. In technical analysis, charts are similar to the charts that you see in any business setting. A chart is simply a graphical representation of a series of prices over a set time frame. For example, a chart may show a stock's price movement over a 1 year period, where each point on the graph represents the closing price for each day the stock is traded. Figure 1 provides an example of a basic chart. It is a representation of the price movement of a stock over a 1.5 year period. The bottom of the graph running horizontally x-axis is the date or time scale. On the right hand running vertically y-axis, the price of the security is shown. By looking at the graph, we see that in October 2004.1, the price of this stock was around rupees 245, whereas in June 2005.2, the stock price is around rupees 265. This tells us that the stock has risen between October 2004 and June 2005. Now, many people have commented on previous video that they want a live example, live chart of current stock, but it is not possible. See, in learning, I can't go and find where exactly I will get which pattern that I want to show here. So it is very difficult to find out from so many scripts, from so many charts on so many different time frames. So whatever I am having, I am using it as an example and showing you all the chart so you can understand it very clearly. And that is the reason I am not sharing any live chart, any live script chart, and I hope you are able to understand that how long it takes for one chart to find exact what the learning process, the teaching is going in a step by step manner. So it is better to show you example rather than going with live charts, because main thing is the basic should be very clear. A supporting chart will explain you clearly. So take these charts as an example for learning purpose rather than going for live charts or from any current script which is having similar setup. Chart properties. There are several things that you should be aware of when looking at a chart, as these factors can affect the information that is provided. They include the time scale, the price scale, and the price point properties used. The time scale. The time scale refers to the range of dates at the bottom of the chart, which can vary from decades to seconds. The most frequently used timescales are intraday, daily, weekly, monthly, quarterly, and annually, yearly. The shorter the time frame, the more detailed the chart. Each data point can represent the closing price of the period or show the open, the high, the low, and the close depending on the chart used. Intraday chart plot price movement within the period of one day. This means that the time scale could be as short as 5 minutes or could cover the whole trading day from the opening bell to the closing bell. Daily charts are comprised of a series of price movements in which each price point on the chart is a full day's trading condensed into one point. Again, each point on the graph can be simply the closing price or can entail the open, high, low, and close for the stock over the day. These data points are spread out over weekly, monthly, and even yearly timescales to monitor both short term and intermediate trends in price movement. Weekly, monthly, quarterly, and yearly charts are used to analyze longer term trends in the movement of a stock's price. Each data point in these graphs will be a condensed version of what happened over the specified period. So, for a weekly chart, each data point will be a representation of the price movement of the week. For example, if you are looking at a chart of weekly data spread over a 5-year period and each data point is the closing price for the week, the price that is plotted will be the closing price on the last trading day of the week, which is usually a Friday. The price scale and price point properties. The price scale is on the right hand side of the chart. It shows a current it shows the stock's current price and compares it to the past data points. This may seem like a simple concept in that the price scale goes from lower prices to higher prices as you move along the scale from the bottom to the top. The problem, however, is in the structure of the scale itself. A scale can either be constructed in a linear, arithmetic, or logarithmic way, and both of these options are available on most charting services. If a price scale is constructed using a linear scale, arithmetic scale, the space between each price point 10, 20, 30, 40 is separated by an equal amount. A price move from 10 to 20 on a linear scale is the same distance on the chart as a move from 40 to 50. In other words, the price scale measures moves in absolute terms and does not show the effects of percent change. If a price scale is in logarithmic terms, then the distance between points will be equal in terms of percent change. A price change from 10 to 20 is a 100% increase in the price, while a move from 40 to 50 is only a 25% change. Even though they are represented by the same distance on a linear scale, on a logarithmic scale, the distance of the 100% change from 10 to 20 will not be the same as the 25% change from 40 to 50. In this case, the move from 10 to 20 is represented by a larger space on the chart, while the move from 40 to 50 is represented by a smaller space because percentage wise it indicates a smaller move. In figure 2, the logarithmic price scale on the right leaves the same amount of space between 10 and 20, and it does between 20 and 40 because these both represent 100% increases. And with this, today's session is over, and we will continue part 5 in next weekend. And before signing off, I would again like to request you all to share YouTube channel on different social media platforms, and do not forget to hit the like button and subscribe button. Till that, see you next weekend, and have a happy, healthy and wealthy new year 2021. See you all. Take care. Bye bye.